Hello and welcome to Switzer Investing TV. I'm Peter Switzer, thanks for joining us. And on the program tonight, I secured an interview with Peter Gray, who's the Chief Operating Officer of Zip Co, or Zip as you might know it. That was late last week. And I'm really interested to see whether he thinks this company has potential. It has clearly been smashed by the market. It was about $12 stock and is now around the 50s. And some of his observations were quite interesting. But before we catch up with Peter, I want to talk to Jun Bei Liu about the enthusiasm for the stock market for a thing called AI, artificial intelligence, and how companies like Appen are doing a lot better than they have in the past. I'd like to see what she has to say about AI and the companies that might be beneficiaries, but also what she thinks about Zip. And then we finish off with Marcus Bodgan of Blackmore Capital. He's also the fund manager for the Switzer Dividend Growth Fund. I'm keen to see whether he's seeing potential in AI and how he's investing in his largely income-focused fund. So that's the show. Let's kick off now with Jun Bei Liu of Tribeca Alpha Plus. Okay. Welcome to the program, Jun Bei Liu.
Thank you, Peter, for having me. As you know, I love to talk about stocks.
You do. And hasn't two little letters excited the stock market? AI.
Oh my goodness, it's stock market, it's media, it's almost everywhere we live. And the other day, I think my 12-year-old was telling me she talked to ChatGPT all the time. And, I'm afraid, quite frankly, a lot of homework will be moving online. So it is everywhere and it's developing so quickly. Yeah. Investors at the moment are sort of trying to work out who will be the beneficiary and, of course, which sector will be hurt in the process. But it's a bit harder to see where it might be. But there's a few early tech companies that sort of benefited from that kind of interest at the moment.
Okay, well, obviously Appen is one of them that suffered for a long time. Was a company that had fantastic performance and was probably a good-looking company, but over the last couple of years has been smashed. What is its AI potential, do you think?
Yeah, so AI potential for Appen, it's a longer dated, but Appen does operate in that area, the AI space. So it's almost like the last mile of the AI, where they provide relevance. So they have people sort of helping the machine to learn our expression, our wording. So the biggest contract to biggest customer, Google and Facebook. Google and Facebook has been using Appen's services for a very, very long time, so they are the incumbent in that kind of relevant space. So and it is that technology that they are trying to work with a few leading AI businesses, very early stage. They're yet to make any, I don't think there's any material earning from it yet. But it is certainly something that could potentially become large, but we're just not sure how quickly.
So it's speculative at this stage, but they seem well positioned.
They're well positioned, and look, currently it makes them more speculative is because the existing core customer, these two big customers, are actually cutting costs in that space. So earnings going down quite rapidly, while at the same time, blue sky will still need a bit more firm contracts and things to come through.
Yeah, and I've heard that they're saying that they will also be monitoring the answers that these AI software programs like GPT-4 and all that sort of stuff. What they're putting out, they'll actually monitor them to make sure that they're not giving out silly and stupid answers.
Exactly, just to make sure that it is the right outcome. That's what people want. So as you know, the AI is self-developing really, really quickly. So the organization need to make sure that it still fits the bill. Ultimately, it is machine learning. We still need to help them to get to the right outcome.
So obviously at Tribeca, you would be poring over the potential companies that might be big beneficiaries. Have you come up with one?
Yeah, so NextDC is a logical, that's an easier one. Obviously, it's because more usage of data and things. It will lead to more demand for data center. But the current data center heat intensity or energy intensity is still yet to match what is required. So there will be a lot more new developments and things. So the demand is going to be explosive. So that's in there. Now, Megaport is another one, seem to potentially benefit from from that, as the smaller company might want to do this. But look, it's still a little bit longer dated to still work out whether it's going to be a real one there. One other name that not many people have touched on is actually Promedicus. So Promedicus, obviously they do the imaging side of things, but its product is actually AI native. So the way it streams its services essentially through AI, or through cloud sort of system, and it is essentially the easiest way for AI to be applied to that. They actually now at the moment are working with a few companies on that AI extension in the future when there's need for AI to working out imaging, reading. This company is already at the forefront.
One other company I wanted to talk to you about, and I figured they may well be beneficiaries, is IDP Education, because they're an online business, and a lot of their educational products are probably created by human beings, and then disseminated to their customer base. You would think that there's potential benefits to a company like that.
Look, I think so. I think any well-managed businesses with a great company management, they will have the vision to try and benefit from this, because AI is going through every sector. And for IDP, they already have the online learning and the way online sourcing students and the platforms and the like. I would expect them to have very good investment into that area, and then they will benefit. It's funny you mentioned IDP. Recently share price has been sold off on the back of that they lost exclusivity in terms of English language in Canada. But look, my view is that it's being sold off so much, something like 15%, on the basis of something, exclusivity that was meant to end, in 18 months, it's just a little bit sooner than expected. I think it's really, being oversold. At the same time, when you have the student placement business where, they're going through this whole huge pent-up demand over the next couple of years, you will see company grow high double digits for the next few years, just really to match the pent-up demand in students. Beyond that, could be AI, could be so many optionality this business could have. So I really do think this one has been oversold.
So it's one of the buying opportunities.
Absolutely, yeah.
Yeah, absolutely. All right, so any other companies that come on your radar screen, unrelated to AI, but you think, the market might have overreacted?
Yeah, look, actually, there's quite a few names in the last month or so. As a company update the markets and things like A2 we talked to before. Earnings growing, Daigou channel returning a little bit slower than expected.
And Bubs, its rivals, having a few problems as well.
But Bubs is very different because they have pinned a lot of hope into the US market, where they got the temporary license. Now the US market, the existing incumbents come back with the volume, and then the market is very competitive for the temporary contract. So look, it's quite different on that basis. Whereas A2 got strong balance sheet, got lots of cash sitting on balance sheet. So got China returning. It just need the students to come back, and we just talk about the student. It's coming. So I think net it should really look through. Actually, it is going to be a good result. It's growing at 17%, not 20. So still very strong earnings growth. So that is one thing looks really attractive. I think there's a couple of China-related sort of names being sold off. I think this is the time really to look at them.
Can you name them?
Well, there's a couple of them. So, the resources name is sort of the ones that's sort of, looking interesting because people are worried about, what is to come. But I think the easiest one is the Treasury Wine, because it's a very high quality company. And there's a little bit of a disruption in the meantime. But, you've got the tariff potential news on the horizon.
Oh, well, Jun Bei Liu, I'll drink to that suggestion. Thanks very much.
Thank you.
Hey, wait a minute. Before you go, I interviewed Peter Gray for this program today, and Peter was Chief Operating Officer for Zip, he is reasonably optimistic that the business can improve, particularly from its current share price. What's your take on Zip and the whole buy now, pay later space?
Of course, yeah. So we always maintain it needs scale. So, Zip needs to combine with another large business to build that scale. And I think it's good that they have path to profitability. They kind of just need to get there to really demonstrate they can become profitable and scale is very, very important. Now, I think latter part of this year, we're looking at there's a couple of IPOs of newer payments business coming through.
More.
Yeah, but they're different. So there's this this one, which looks really incredibly interesting. It's vertically integrated, so it's not just one area; it's everything.
Yeah.
It's got great market share. So look, maybe by then, there's a bit more interest might be generated back into the space, because right now there's a lot of investors that haven't really looked at the space for quite some time.
Yeah. The one thing he said to me, which I hadn't thought about, was he said, we are seen as a buy now, pay later company, but we see ourselves as a fintech company. And he said that what we've created with buy now, pay later does create opportunities in so many other areas. And I said, well, I guess I'd never thought of it that way. Had you thought about them as being a fintech company rather than a buy now, pay later company?
Yeah, absolutely. Look, it is a fintech company, and then they could potentially, it's got a lot of customers. So, a lot of customers use its product, and daily throughput is enormous. So it will be incredibly valuable to actually sit with another larger business. We always talked about whether it's banks and things, but really actually it comes down to whether Zip, they can grow with a bank, right? So, it's their choice to really where they can bolt on. Maybe it's a large retailer, maybe it's one of those large business to leverage that.
They certainly do look like a takeover target for the right business.
Yeah, that's right. So it's not going to stay long.
Okay, great. Thanks for joining us.
Thank you.
Thanks for joining us, Pete.
Pleasure. Thank you.
Well, it's been a tough couple of years for you guys, and let's delve into it. A lot of people don't understand, why your stock could go from $12 down to 56 cents where it is today. But I had a look at what the analysts are saying, and the consensus is that you should be 46% higher. Shaw and Partners, they love you, and I guess you love Shaw and Partners as well, because they think your share price should be 260% higher, which I'm sure you totally agree with. Orbinet 16% higher, Macquarie 10% down, Citi's 16% down, UBS 19.6% down. So it's a split view on what the company is doing. Who's right?
Yeah, great question. Look, I think there's significant opportunity for us to continue to grow, and the share price aside for the moment, I think a couple of the analysts might understand the business and the space clearly better than others. I think to some degree, with the smaller cap, maybe less work has gone into us most recently. I think it wouldn't be denied by some of the analysts providing coverage, but I think it really depends on your view, if you're placing us as a fintech or just a pure play credit provider. And I think arguably we're definitely on the technology side of credit, which actually significantly expands the opportunity. So I think when you're sort of factoring in a broader range of growth opportunities in the future rather than the current risk settings, I think it's certainly much more upside.
Okay, so you're saying you're more a fintech company, and the alternative, a straight credit business, why aren't you that?
Yeah, I think we're highly leveraging technology to deliver, what might be described as more traditional credit products in a different way, which enables us to, be highly engaged with the next generation of financial services users. So effectively acquiring customers via the app in real time online, the way we're able to communicate with our customers, in different ways is actually giving higher levels of engagement and trust, and that's delivering significantly different potential for customer lifetime value.
Okay, so are you saying some analysts might be thinking, well, they're in the buy now, pay later space, and that has less potential than it did 2 years ago. You're saying we can be more than that. You could be selling other financial services down the track.
100%. And I think even if you looked in a market like Australia, which, we're entering our 10th birthday next month, I think, to some degree, buy now, pay later is an entry-level product. It has the ability to acquire customers for a very low customer cost of acquisition.
Right.
You are the benefit of high levels of trust and customer engagement. So that gives us the ability and the right to play to offer traditional or more traditional products, but in a different way, which deliver higher returns and much higher future customer lifetime value.
So let me be hypothetical, and you're making me think. I know it's unusual for people in the media to actually think while they're asking questions. We come with questions, but it seems to me that you're saying that if I came to you and said, Pete, I had the best idea for selling financial advice online, you wouldn't say no to the idea of exploring it as an option.
Yeah, I think I'd consider us a next generational financial services player.
Yeah.
So I think the opportunity to deliver highly accretive products to our customer base is real. And in fact, the next level of step change growth for our business will be through product innovation and new products in a market like Australia. Again, we haven't really delivered any new products for some time, and that is on our short-term roadmap.
So you're basically saying there's blue sky out there, but a lot of people aren't seeing it.
Totally.
We believe that it is out there waiting for us for the clouds to part.
Absolutely.
Okay, so go back to that issue I brought up earlier. You were a $12 stock, you're now 56 cents. The first question I've got here is, has the market got it wrong? You've implied, well, they just don't see what we know we're going to put on the table for this company down the track.
Yeah, 100%. I think if you sort of dial back 2 or 3 years, to a pure play BNPL operator in a low interest environment, the margins are obviously significantly stronger than they are when you suffer small compression due to interest rate rises. But I think the fact is that BNPL is just phase one of our business opportunity, and we will be expanding our product set very, very soon, which delivers significantly better outcomes.
Okay, so this next question probably is less impactful now as compared to when I wrote it. It says competition has escalated. So that's relevant to maybe the share price we see today, because if we just see you as a buy now pay later business, competition has escalated. That would be part of the explanation why your share price is lower.
Potentially, I think we've moved more broadly in line with other growth and tech stocks in the face of rising inflation and interest rates. I think there might be some factoring in of competition. But in a market like Australia, I would actually suggest that competition will decrease off the back of consolidation and impending regulation. So I would suggest that...
How many players are there now, Peter?
Well, I think there's probably 3 is what I'd describe pure play BNPL. Klarna's obviously decreased their position reasonably significantly in terms of the investment over the last 12 to 15 months. They haven't necessarily nailed their go-to-market opportunity off the back of a couple of different attempts. I think the banks have some products in market, how they continue to offer those in the face of regulation. And I think PayPal's obviously endeavoured to gain some market share. Again, how they're structured or set up to be able to comply with impending regulation will be a matter for them.
So you're basically saying you and Afterpay still are the main forces in this market?
Yeah, absolutely. I think, we have seen, Hum and Latitude pull back their BNPL offerings. We've seen the collapse of some other offerings, which does enable us 2 opportunities. 1, to increase our market share from checkouts where they had a presence, but 2, also to penetrate verticals where they may have been stronger. Okay,
so you implied something that I thought, if you look at the chart, and we'll get the chart on screen now, but your first big drop down was when the likes of PayPal came in the market. The next drop down, you were still a reasonable price, around $7 or so. I hadn't started to hate you by that point in time, Pete. The next one was when the tech companies fell, and a lot of payments companies copped it as well. But you'd say, well, maybe the people who sold off understood we are a fintech company, and fintech companies copped it.
Yeah, and also I guess negative sentiment, given that we do bridge that fintech and lending businesses, and interest rate costs obviously do
a double whammy in a sense.
Double whammy.
Yeah, and of course higher interest rates at the moment would have hurt your bottom line as well.
Yeah, I think that's very true. I think our latest results really did demonstrate, though, that we have a number of levers to maintain margin, and even in the face of rising interest rates, our group margin rose from 2.5% to 2.8% per transaction. So our ability to sort of control that revenue margin and losses to offset rises in interest rates was demonstrated very, very well.
Okay.
Strength of the business model.
What about regulation? You've been hit by new regulation. It was the kind of regulation you thought you could live with.
Yep.
Is that going to be a big negative for the business?
No, we believe it'll be actually very positive for Zip in a number of ways. So we have advocated for fit-for-purpose regulation since 2019. We put forward a submission to the Senate inquiries into how we saw that the space might be regulated. We've been heavily engaged with Treasury for the last 12 to 15 months on identifying appropriate frameworks that might be applicable. We applaud them for landing on option 2, which provides a great balance between providing consumer protections but also promoting innovation and competition, which we believe is critically important. Effectively, that will see all providers required to have an Australian credit licence and conduct a scalable, responsible lending check on new customers. So that's actually business as usual for Zip. So we do ID, credit and affordability checks on all our customers. So there's effectively no change to the status quo for our business. However, most of our competitive peer set will have to have some reasonable adjustments to their business model. We believe that'll lead to further consolidation. And I think more broadly, actually having clarity over the regulatory environment removes a dark cloud of speculation that's constantly surrounded us. So it might open up new pools of investors to support the business given that uncertainty has been removed.
And for your rivals to embrace the regulatory requirements, will it be significantly costly for them?
Yeah, I believe it could potentially be. So there's a little bit of finer detail to be rolled out in the next couple of months with regards to Treasury and the finalisation of that obligation of responsible lending. But I think if you sort of consider our competitive peers aren't doing credit checks, and they're certainly not doing any income and affordability assessments to their new customers. So you think of the levels of friction that might impose on some of their onboarding. You looked at a business like PayPal, who has no control over their tech stack in a market like Australia. How they would fit the changes into a global roadmap become problems for them to deal with for sure.
Okay, so the shorts, about 10% of your stock is in their hands. Do you ever get a chance to talk to them and try and convince them of the error of their ways?
Occasionally, yeah, probably less so. I think pleasingly there has been a reduction lately in the short interest. I think we are really demonstrating the pathway to acceleration to profitability. I beg your pardon, and we're well on track for that, and remain very much on track with our guidance.
So, I had another great question which you've kind of partly covered, and I said, what will prove the shorts wrong? And the first question is company initiatives. So you've kind of implied it. What do you think is going to be the standout company initiatives that will excite the market eventually?
Yeah, I think there's really two catalysts in the short term. One is achieving the objective and stated pathway to group profitability in early FY24. Right. And I believe we also will need to make some further inroads to our liability management. We have large liabilities by way of convertible notes with a reasonably mature date in the future, but I think to continue to demonstrate how we're able to manage those liabilities will really be a catalyst for the business, and then following on that, product innovation, which should open up further growth opportunities.
Are they at good interest rates or prohibitive interest?
They're zero coupon. It's so they were again opportunistic at the time, and we have plans in place to deal with them as we did last November, where we were able to retire $70 million at 23 cents in the dollar.
Okay, I guess. You are the kind of person who I would imagine prays before he goes to sleep. Are you praying for cuts in interest rates?
Yeah, look, I think they'd be helpful, but I think arguably we're closer to the top than we have been before, and I think we've demonstrated that we can still run a very profitable business with many levers at our disposal. So probably more praying for New South Wales to get a victory over Queensland, but it's all in the mix.
Yeah. I have recorded you before Monday. We're going out Monday, but okay. I will make the point that it's good to see you are a very supportive New South Wales rugby league supporter. I guess the final question then gets down to how long do you think it will be before the company will be showing signs that are consistent with your expectations about the positive future for Zip?
Yeah, I think FY24 is going to be a huge year for the business. I think we've demonstrated off the back of our sort of strategic adjustments over the last 12 months, we've done a lot of hard yards, reducing our global cost base, and I guess recession-proofing the business in terms of maintaining margins and disciplined control on credit losses. So how we emerge from that pathway to profitability to being profitable, but then also demonstrating the next level of step change growth that is available to the business on a profitable basis. And I think that's coming in FY24, so it's a really exciting year for the business.
Now, one final one as an economist, I am interested about looking at other indicators than the ones we normally look at. You must have a reasonable handle on how your constituency is handling higher interest rates.
Yeah.
What are you seeing, Pete?
So I think we see a couple of things. So on the retail side, we do see market leaders maintaining a very strong position in terms of market share. The likes of JB Hi-Fi, Bunnings, and these sorts of providers who we have good relationships with are continuing to deliver strong outcomes, even though broader retail is softer. So it demonstrates that smaller businesses really are starting to suffer. I think on the consumer side, We have seen a slight softening in credit performance, so that's clearly impacted by both seasonality. The first half of a calendar year is typically slightly softer, but also we do see that interest rates and inflation really are starting to have an impact on credit. Clearly, employment remains a strong driver of credit outcomes as well. So I think the ability of us to respond to early indicators and keep control over our portfolio puts us in a better position than more traditional credit products. Again, we touched on that earlier. But so there is starting to be a softening in consumer as well.
Okay, mate. Thanks for joining us. Good luck.
Pleasure. Thank you.
Peter Gray, co-founder and CEO of Zipco. Marcus, thanks for joining us.
Pleasure to be here, Peter.
Now, we know that your focus is on income, but you do also go for growth. And US markets have been very excited about two little letters, AI. And so is AI going to affect the way you invest going in the future?
It's something which is incredibly topical, and whilst we can't participate directly in significant large AI companies in Australia, I think what will eventuate is a broadening out and a focus on those companies which will be really beneficiaries of artificial intelligence. And one area that really does stand out is in medicine, particularly in imaging and diagnostics. They're already doing a lot in that area already, but we do think that that will be an area where significant productivity gains can be made. And so that is one area that, you know, for a range of reasons why we're invested in, but that would be an additional reason why we would think that the revenue for these types of companies will be significant.
Yeah. Now we've seen in America, it's a pretty easy way to find out what companies are big beneficiaries. We know Microsoft is, Nvidia clearly was, Meta, Amazon, Alphabet, all of them showing a real lot of interest and they're investing heavily in it. Is there a local company that you think as a standout will be potentially or definitely a beneficiary of AI?
Well, I would go back to my original thesis around pathology and imaging, and the company that we do have in the portfolio is Integral Diagnostics, which is a fourth largest radiology company in Australia. I think they'll be a key beneficiary, but I do think you'll see the benefits will be quite broad. You know, Woolworths already has invested a lot in data, and I do think those types of companies will really embrace AI in terms of their delivery of you know, further productivity improvements.
Yeah, and look, we've talked, you know, for decades really about Australia's worrying productivity levels. Do you think AI is going to be a bit of a game changer for productivity? Because I can see it from two angles. One is it will help in generating revenue, but it potentially could be a cost cutter as well, whereby you're using less people and more capital technology, which ultimately is a recipe for higher unemployment, but certainly greater productivity.
Well, I think when you have seen these game changers in industry through economic history, you haven't had the subsequent uplift there in unemployment. People do other roles. And I do think this has to be managed incredibly carefully, and there's already very heightened concern about, you know, the potential impact there. A lot of this is unknown, but I do think that, you know, particularly those large corporates will be able to use this to improve productivity for their workers.
What about a company like Sonic? Is that still in your portfolio, and would that be a beneficiary?
No, it's not, but it's a company that we keep a very close eye on, and I did see their operations more recently when I did the healthcare tour in Europe. And again, pathology like imaging is will be one of the key beneficiaries of AI, but also more broadly in diagnostic medicine. They're the sorts of areas you want to be invested in, because going forward, it's all going to be about testing.
I was recently talking to one of the portfolio managers from WCM, and he was saying that healthcare is a sector they think has a good future, and they're investing accordingly, and tech, and also luxury. Is there any luxury plays in the Switzer Dividend Growth Fund?
No, and we don't have the availability of those great big luxury brands that you have in the United States, in Europe. Although those big luxury brands are becoming a far more significant component of companies like Vicinity in terms of their shopping malls. And where those luxury brands are positioned, and the level of queues that go into those. And so that would be an indirect way that you could participate in that theme.
Okay, and so what's your view on the shopping centres? You know, in the age of online shopping, two areas, you know, the shopping centres and also the retailers. You know, I look at someone like Harvey Norman's share price is really low at the moment, but historically have been very good dividend payers. And, you know, I guess for the person who's prepared to buy and wait, they'll probably eventually get a very high yield once retail bounces. Is this the sort of thing that you have to sort of sometimes contemplate? Do we buy JB Hi-Fi or Harvey Norman when the price is low, on the supposition that even when the price is low, there's still not a bad dividend payer?
You're absolutely right. And they've got very strong balance sheets as well. So if you look at the likes of JB Hi-Fi, Harvey Norman, Premier, they're all companies that have paid very good dividends over time. And we wouldn't dismiss the physical retailers. And I think what has surprised many, including the incumbent retailers, is how strong the physical store recovery has been. The recovery in foot traffic and the growth that they're seeing through the centres. Now, in the last few weeks, there have been indications of a slowdown in consumer discretionary activity, but it's one that we'll watch carefully, given the sort of the attributes that you've outlined, that on significant weakness, we do believe that these are enduring businesses. They have strong balance sheets, they've generally executed well over time, and they're attractive dividend yield plays.
Okay. Now, one last area, which has been very rewarding, and I would have thought 5 or 6 years ago, a guy like you wouldn't have bought BHP and Rio for dividends, but they've been great dividend payers. But lately, the share prices have been under a bit of pressure. Are you keeping these guys on the belief that 2024 will be a better year for global recovery, and they then will be beneficiaries, or are you cutting back your holdings of the big miners?
No, on the contrary, at the beginning of last month, we did put Rio back into the portfolio based on the fact that the dividend yield is very attractive at these levels. The balance sheets are very strong, but we're playing BHP, Rio, and other resource companies because we do believe we're in another, significant transition, and that's the energy transition. And companies like BHP and Rio will be front and centre of that as we decarbonise the global economies. And it is all about the metals driving electrification. And so those types of companies are really cornerstones in the portfolio at this point in time, both in terms of their longer term prospects and the need for those core metals, particularly copper and nickel, but also because of the discipline that they've shown around their balance sheets and the attractive levels of cash flows that they're generating, which is generating very attractive dividend yields.
Okay, one last one, the banks. The banks are at relatively lower prices. If I asked you which one do you hold for reliable dividends, I'm sure you're going to tell me CBA, but I'm not going to ask you that. I'm going to ask you, which of the lesser banks do you think look like good value and will deliver good dividends over the next 12 months?
Well, I think they all will deliver good dividends over the next 18 months or so, and they're all priced around 5.5% dividend yields to 6% at this point in time. I think the short-term concern is just the earnings outlook there, the pressure that's been exerted on margin, a lot of competition in mortgages, on deposits and wholesale funds. So we don't think the banks look particularly cheap, but they certainly don't look expensive. And we do believe that those dividends can be maintained. So I look on progressive and further weakness, depending on the sort of the state of the economy, we could add to them, but not yet.
Okay. Great stuff, Marcus. Thanks for joining us.
Terrific. Thanks, Peter.
That's Marcus Bodgan of the Switzer Dividend Growth Fund and Blackmore Capital. And that's the show for tonight. Thanks for joining us. Don't forget, you can go to switzerreport.com.au. If you sign up, become a subscriber, you'll get insights on lots of stocks, many of the stocks we don't cover here. And you also go to Switzer Daily at switzer.com.au. Thanks for joining us. See you next Monday.